Central banks are basically downplaying their purchasing of U.S. Treasuries when they were the number one buyer of Treasuries. And now, of course, gold has overtaken U.S. Treasuries as the number one reserve asset in their books.
The U.S. 30-year hit 5% today. That's a key psychological level. What do you think the bond market is signaling?
There's less demand in general for U.S. bonds as we move forward.
Special coverage from the floor of the World Symposium is brought to you by Palisades Gold. Nomi Prins joins us once more at the Rick Will Symposium. She's been on the show a couple times recently. Check out our last interview with Nomi, link down below, where she talked about the biggest divergences between markets and reality. We'll talk about some of these divergences and the distortions today. Nomi, of course, is a geo-economist and the best-selling author of Financial Distortions. Check out the link to the book, link down below as well. Thank you so much, Nomi, for coming back on the show.
Thank you so much for having me back on, David.
We spoke about financial distortions a lot. Now we're talking about distortions in the real economy, especially with supply chains, something that's critical, something that's palpable, something we can touch, commodities that flow through the GCC, the Gulf countries. Those have been on the radar for a lot of investors, but now a lot of things seem to be normalizing right now with the Gulf countries now producing more oil. We talked about offline. The Strait of Hormuz is still closed. And now it looks like markets and analysts are pricing in a permanent closure and just a toll, like another additional fixed cost that barges have to pay to flow through. And so that's the new normal now. Maybe no more distortion?
Yeah, no, that's exactly right. A lot of the distortion was based on the initial fear of that 20% of oil going through the Strait dislocation and what would happen. And then when strategic reserves were opened by the United States and by Europe, there was some relief for that fear, and oil came down to around the 100 level. Now we're talking about it being in the 70s because other Middle East countries are recognizing that they can go back to production, they can go back to processing, and they can go back to moving, albeit with a fee perhaps, oil through different ways. It's a bit more expensive to move it around the Strait, and there will be a fee to move it through the Strait. The Strait was only operating 6% of tankers going through it post-war versus pre-war. It has loosened a little bit, but there's still a lot more space to go there. So there will be volatility, there will be tension. But what we've seen is, yes, a normalization of that paper traded fear. There's been a lot of this going on throughout commodities, and oil sort of being driven up with this, oh my gosh, what's going to happen next and how long is it going to stay at this sort of suppressed distribution environment. And now we're seeing that, yes, there's a normalization to that. And let's not also forget, oil is an incredibly mature fuel asset around the world. There is oil supply throughout the world. It's a question of where countries get their oil from, where it's being produced, and working around now whatever disruptions have occurred or will or could still occur through the Strait.
Mm-hmm. We'll come back to financial distortions in just a minute. So on oil, just today, we're speaking on the 7th of July. Oil prices rose a little bit after another commercial ship got hit in the Strait of Hormuz. Is it sustainable that other countries are producing more oil and depleting the reserves to bring down or suppress the price of oil artificially? I've seen that word used a lot in media now, artificial suppression of oil prices. How sustainable is that?
Well, that's why I think we're in the 70 to 80 range versus the sort of 60 range that we were at coming into. You know, we saw oil prices down quite a bit, and I think it's going to be difficult to get back down to those levels because when the United States and Europe opened their strategic oil reserves in the beginning of the war period, in order to try to suppress oil prices, it didn't really work at that time. It was a bit premature relative to understanding what was actually happening with the Strait being closed and how oil will be repositioned. But you do have other oil servers. You do have Venezuelan oil coming up through into the southern east part of the states to be refined. You have Colombian oil now being tapped, and some of those companies bringing supply into our hemisphere. And then you have the Middle East countries reproducing and going back to opening their refineries with the anticipation that some of this oil will go through. I don't necessarily consider that artificial suppression. I think it was more of an artificial fear that drove oil up to 138 because there are these mechanisms around the world to ultimately go back and help some of the strategic reserves. But again, it's going to take time to plenish them. And that's why we're going to see this volatility in oil prices jumping here and there. And we'll still see commercial tankers perhaps being hit and making that happen, because there's still a lot of volatility around how quickly it's going to be to replenish strategic reserves that are actually not artificially depleted, but also how the fact that there is the ability to produce and find and refine and reroute oil will be on the other side of that trade. And that's why I think we're in the 70 to 80 kind of dollars per oil, more or less, bound for quite some time.
The University of Michigan Consumer Sentiment Survey showed a slight uptick in the last month versus the month prior, partly due to lower inflation expectations, slightly lower. Are consumers correct to assume that inflation will come back down?
Yes, and that's a really good question, because there's different ways of looking at inflation, and mostly we look at how the Fed views inflation, because that drives headlines and that drives a lot of trading and that drives prices and that drives sentiment. And so consumers are saying, look, oil was, again, very, very high at 138 in the beginning of the war, and how that manifested through the gas pumps throughout the United States and around the world was a significant hit. It cost much more all of a sudden to fill your tank, and that is something that people feel in their daily, monthly, weekly budgets. What they're seeing now is with oil prices around 70, 80, less focus in the news on oil prices and inflation, and feeling less of that pinch at the pump. That's where that consumer confidence is coming up. And yes, if oil prices come down, it manifests mathematically into lower CPI, lower PPI. Now, the Fed will say, and people will say all day long, that the Fed only looks at something called core PPI, which means effectively stripped of food and energy prices. But the way I look at it, and in reality, energy is a part of everything. You cannot strip it out of the other part of PPI. And that's why everything rises when oil prices rise. With oil prices coming down, the net mathematical effect is that those inflationary numbers come down. We've already seen the Fed watch, thinking that there would be 1 to 2 hikes through the end of the year, be at 70% before this oil prices came down, with inflation spiked where it was. And now it's down at 30%. I believe the next FOMC meeting will tell us more about how the Fed is not so scared about inflation, because they will also see it coming down. And all of this will feed into headlines, and they can keep oil in this range and keep consumers a bit more comfortable. Inflation's not going away.
Yeah.
But that it's not going to be in that sort of high 3-4% range when we see the next prints.
Before we continue with the video, let me tell you about one of the most important problems of owning gold. So gold has been a store of value for thousands of years, for as long as people can remember, but it doesn't generate an income unlike many other assets. That's a problem. But that's also where today's sponsor, Monetary Metals, comes in. Monetary Metals offers investors a way to earn yield on their gold paid in physical gold. Through its leasing platform, investors can earn up to around 4% annually, with yield paid monthly in ounces rather than dollars. That means your return is measured in gold itself. The gold remains your asset and can be redeemed at any time. Thousands of investors are already earning a monthly yield in gold through Monetary Metals. Visit monetary-metals.com/Lynn, link down below, or scan the QR code here to learn more and get started, and you can start earning a real yield in gold today. The US 30-year hit 5% today. That's a key psychological level. What do you think the bond market is signaling?
I think the bond market is signaling two things. It's basically a bit late to the fact in terms of inflation. So we did see yields going up because inflation went up, and they're still kind of in that path. But the other thing that's happening is there's just more issuance coming into the US Treasury market because of paying for the war, because of paying for servicing these interest rates payments in general. So we've seen auctions that haven't been taken in quite as well with these higher inflation numbers and with this extra debt as they have been in the past. And what that means is there's lower prices, there's higher yields. So there's a market impact on the fact that we are issuing more debt at higher levels, which then push those levels higher in yields. And that's what we are seeing. And also, in the wake of the war, we saw the dollar going up. It's off a little bit. It's kind of still bouncing around at slightly higher levels because it hasn't fully priced in all of these changes in inflation and what the Fed's going to say next meeting and the meeting after that and so forth. And so there's still a hangover that the bond market feels. And what that also means is central banks are simply buying less treasuries. And they were buying less treasuries when the dollar was up. Investors are buying more treasuries because the dollar was up. And so we have to recognize that there's less demand in general for U.S. bonds as we move forward. So there's a lot of different factors that are impacting the price of US bonds and driving those yields up at the same time.
Speaking of the Fed, what should the correct policy be this year, and what would constitute a policy error for you?
I think the correct policy right now is to hold rates where they are. Not hold rates where they are because we're waiting to raise them. That's really the wrong message. I think the Fed really does need to wait to see how these lower oil prices manifest in the data and not raise rates just to kind of save face about their ability to fight inflation. I think in general, a 25 or even a 50 basis point move in rates does not impact inflation. What impacts inflation are supply chains moving, are supply chains rerouting, are other forms of energy sources and other commodity sources moving around the world in different ways. This is what brings inflation down. What the Fed does doesn't. So I think it would be a mistake. A big mistake to raise rates by 50. I think it's a big mistake to raise rates in general. And also, if we look at the last employment report, it actually was not awesome. We are still running at 4.2, 4.3% unemployment. That's a little smidge higher than what the Fed actually wants. So I think we could even potentially see an easing of rates. I don't think that's going to happen in the next meeting or the next two meetings. So therefore, I would think it'll also be a mistake to do that. So I think really doing anything right now would be reactive on the part of the Fed relative to waiting. And also, I had this conversation with a lot of people, and a lot of people actually sort of in the Fed in general, about the last Kevin Warsh meeting and what he said and how the media interpreted what he said, which was very little. It was a very short statement. It basically was a rewording of what Powell used to say, which is that we are data dependent. And so there was a lot of headlines about whether he's now a hawk, whether the Fed, again, that FedWatch number went up to 70% on rate hikes and all of that. I think he was basically showing his independence without necessarily doing anything about it or taking too hard a line about forecasting forward. I think that's actually a strong move on his part, because even though he was appointed by President Trump and he has a relationship with President Trump, and in the past he has been mostly dovish. You know, he voted on the board for, as you know, we've talked about, for QE and everything else during the financial crisis. I think it was like a power move to say less in order to show independence, in order to, I think, ultimately cut rates. Again, not now. But meanwhile, the Fed's book is growing. So under end of Powell, under beginning of Warsh, the Fed's balance sheet, they don't call it QE, but it is growing by the same amount, as it turns out, as the value of the US 10-year auctions. So the Fed is still maneuvering in the background. So I think him projecting very little, and the markets, I think, reacting hawkishly to his non-statements was overreaction. And I think we're going to see at the next meeting a sort of neutralizing, pulling it back, because that's what the data will show. Yeah. But I think ultimately then he will look at the economy, the FOMC will look at the economy and the jobs market. And I think that will lend itself to the easing bias that we actually see in the books of the Fed right now.
And that's the key that people should understand, which is what you brought up. The Fed can still buy assets even though they're raising rates.
That's right.
Now, Warsh was an outspoken critic of QE back in the Bernanke days. In fact, I think he quit because they had a spat over that. But anyway, I wonder what's going to happen now with the balance sheet. Now we have Warsh, who in the past didn't like QE following the financial crisis. Well,
I think QE has been a great trend. He had one argument about QE, and all the other arguments and all the other votes about QE, he actually went with QE during that period. So he basically dissented on one, and that was a later one. So yes, he has an opinion, which again, I think is good to have for a Fed chair. But the Fed has still been, it basically abdicated its quantitative tightening bias in December. And its book has basically raised by 40 to 50, net 40, but basically 40 to 50 billion a month since then, which is why it's at a higher level now. I don't see them going to a QT. I don't see them stopping what is already in motion, which is effectively QE, but not called QE. And I think he has that tool. The Fed knows it has that tool. And going back to what we were talking about earlier, if we're in a world, which we are, in which central banks are basically downplaying their purchasing of US Treasuries when they were the number one buyer of Treasuries, and now, of course, gold has overtaken US Treasuries as the number one reserve asset in their books, having overtaken the euro last year, this is going to continue. they are going to, and they've said they're going to continue to buy gold. They're going to continue to divest treasury bonds or not buy as many in order to change their allocations in terms of reserve allocations. And the Fed knows this. It knows it needs to protect ultimately the treasury market, which is why it went off of QT last year to begin with. I don't see Kevin Warsh changing that at all.
So
in
what
other words, we
happens-
continue QE in the backdrop.
Okay, so under that scenario, let's say the markets are right, because right now the CME Fed Watch is still pricing in a high chance of at least one rate hike this year. We have QE in the background and a hike going on in the foreground. What happens to the economy in that scenario?
I don't think a 25 basis point hike, if that's ultimately what manifests this year, is going to change the economy one way or other. I think that is a very limbo statement. Because again, I don't believe the Fed's going to turn around and stop that effective QE in the background. And in fact, if we did see any economic issues because of higher prices, let's say corporations have cut back and we see some of those numbers come into the next quarter of quarterly earnings, or we may not. But if we do, I think the Fed's going to look at that and say, okay, we also don't want to slow down the economy. But at 25 basis points either way, I think it's more of a headline thing to say that scares people and that has short-term impact in terms of moving the dollar or in moving treasury bonds. But ultimately, there are less buyers of treasury bonds than there have been in the past. There's more debt than there has ever been in the past, and it's only growing more quickly. So under that scenario,
given how much money supply they've already increased in the last couple of years, do you think that their toolbox of monetary policies has become more or less effective in combating inflation and controlling unemployment than, let's say, 30 years ago?
I think that the fact that inflation came down over the last few years, before the sort of Iran oil period, but it was coming down, was very much a result of external structural factors than the Fed or even than other central banks. Because what's also been happening around the world, and particularly recently, is producing countries or countries that have more independence on their oil or their commodity supply, like Brazil, like Russia, have been actually reducing their rates versus, these sort of minor conversations about raising with respect to other central banks. So there's been a sort of split movement anyway going into this period. In terms of central banks and how they move. So I don't think the Fed is really impacted. I think the Fed wants to believe it has. I think Powell wants to believe it has. But the Fed started reducing rates way before, and it hasn't gotten to 2% inflation, which is its inflation benchmark. So it's using we're over 2% as a reason to raise rates when it was in the raising rates period post the Ukraine-Russia war. But now, since they started their entire easing campaign and now they've stopped for a while, inflation is pretty much where it was then. I don't think the Fed can impact inflation with these incremental movements. There's too many international, geopolitical, and commodity supply chain factors that are actually why inflation rises or falls in the commodities that we produce as food or that we use as fuel. I think the Fed, therefore, does not have as much of an impact as it did in the past, but I think it likes to project that it does.
Does anything change when it comes to foreign demand of U.S. assets following the closure of the Strait of Hormuz and the fact that people can see that the U.S. has been ineffective in keeping it open, and now the rest of the world still has to pay a toll?
The rest of the world is actively, and I think more rapidly, trying to figure out how to take its supply chains more independently, whether that's in rare earths, whether that's in uranium. The U.S. is doing the same. Japan is trying to do the same. It's just been hit with export controls on tungsten by China, and it has to figure out how to sort of maneuver those costs, whether they're down chain or whether they're, sort of moving their structure in different ways. So the world is actively doing this. It's not looking to buying U.S. treasuries or necessarily investing in the dollar as a solution to their long-term strategic plans for their economies, and that they use to ring fence certain commodities or the supply chains that come through or from those countries. So we're in a very different world now where the game is way more about controlling whatever aspect of a supply chain you can control as an economic and a strategic weapon effectively, or power amassing tool effectively, than investing in U.S. treasuries. That said, other countries and nations and asset managers will gladly invest in the S&P companies on a sort of private equity level, because the ones that show upside, and they'll just hedge out the currency risk on the other side. So we're seeing a sort of divergence of that investment into stocks, which we've been seeing, versus investment into basically the future of the U.S., which is the U.S., which would be the U.S. Treasury. We're seeing that demarked and down.
This divestment that we're talking about now, have we seen any evidence that this divestment has extended into investments into gold and alternative assets away from the dollar? In fact, I've seen the contrary. Turkey, for example, has been selling its gold the past quarter. So what are other central banks doing?
So Turkey's an interesting example because it was one of the most rapidly accumulating gold central banks in the last few years. And so it monetized some of the gold at much higher prices than it had originally bought gold. So what Turkey did a few years ago, it bought gold when it was sort of 2,000s, 2,500, 3,000, and it monetized it out at 4,500 to 5,000 and down to 4,000. So it's a very unique example of being very early as a sort of relatively small central bank in this gold buying process. Now, that said, if we look at a bigger bank like the People's Bank of China. So the People's Bank of China in 2014 through 2018 basically held about $1.3 trillion worth of US Treasury bonds. By the end of last year, that number was down to 750 billion, so almost in half. Right now, it's at 620 billion. So less than half of where it was basically a decade ago. So China has, as a large central bank, has been buying a larger portion of gold. It's still only 5 to 6% of its reserves. So they have a lot to go to get back to the 11 to 12% of reserves that it held or bought in the wake of the financial crisis, when nobody was paying attention to what central banks were doing with their gold or treasuries, because all of the numbers were much smaller. But on a percentage basis, they and other central banks have a lot of room to go. They have no interest. In other words, their treasury drawdown or selling or lack of buying is even more rapidly outpacing their buying of gold. Both things are happening. They have no interest in going back into the treasury market. I can see a situation where 4 or 5 years from now, they own, basically just a little float of treasuries to maneuver in international markets, and the rest is all other currencies, their currency or gold. And I think that's where we're going with some of these banks. It could take a few years, it could take, up through a decade, but that's where they're going. And that gets us back to effectively also the levels of, pre-1971, pre-gold standard, where it mattered to buy the dollar because you could convert it into gold if you were an external central bank. The world was different. Superpowers were behaving differently. But that is where we're going forward to basically recapture where gold is. So the World Gold Council, I know you've undoubtedly reported on this, did their recent survey, which said that 45% of central banks, which is its record in its survey, are planning to buy gold or add gold to their reserves this year. When you add gold, you deplete your treasuries. That's just how it works. If you're gonna keep your cash balance the same, you need to buy it with something. In other words, so what do you have the most of? Probably the US dollar, probably US treasuries, even though you now have more gold for some central banks. That's what you use to buy your gold. So we have to be careful when we look at who's depleting gold and why they're depleting it in order to purchase it, and who isn't depleting it at all in order to continue to purchase it. And that is 45% extra of these central banks, and particularly the larger ones, particularly China. I think Brazil is going to be buying more gold than it has, for example, as a major commodity producing nation. And so I think there's a lot of central banks that are still not even on the same past few year gold buying spree, but are in the consortium of central banks that are, in terms of geopolitical and economic partners. And I think there's going to be more gold buying coming from them as well that we haven't even seen yet in these surveys.
But it's maybe they are, maybe they're not. But are they actually preparing for some sort of return to the gold standard, or is it just because they have a certain level of gold that they need to maintain in their reserves, as let's say a ratio, for example, and if those reserves overall needs to increase, then gold's portion needs to increase as well?
So it's a good question, because if we go back to what the role is of central banks for their own economies, not outside in the world, but basically as a sort of regulator and liquidity provider and enhancer of integrity of credit integrity for their own banking system. We look at People's Bank of China. They have effectively made a situation in China where all of the state banks now have to have a certain amount of gold, where all of the other banks that have retail investors are pushing gold down to the retail level. So it's not just the central bank that's buying. What's happening is when the central bank accumulates more gold, its entire system runs more on the idea and the fact that there is more gold in that system than before. So it's something that goes from the top down. And what that means is, if we look at a gold standard, we whether we call it that or not, the implicit guarantees from the central bank down to the bank level, down to the retail value, start to get more and more backed by gold. So the idea of the gold standard was an official convertibility into gold. The United States would take dollars and give gold at a ratio, over the years, and then they stopped.
Yeah.
We may not get back to that kind of instant convertibility at the teller of a small bank in any country because the central bank owns gold on a regular basis. But implicitly, we have a situation where more gold backs more trade agreements, backs more convertibility and payment systems because it's more infused into the entire financial system from the central bank down. So on that basis, we are moving towards a new kind of a gold relative collateral environment, let's say, than effectively an official standard, but we are moving towards a financial system that increasingly relies on gold.
Okay, so going back to your earlier statement about how countries are diversifying their supply chains, the world has spent decades, Nomi, building efficiency, decreasing costs through globalization, but yet it seems like if they're reversing that, people are willing to sacrifice efficiency and lower costs for resilience.
That's right.
Are they actually willing to do that? And if so, what happens to consumers?
There will be certain costs that do reach consumers. And there's same kinds of costs that can happen if there's an event like the Iran war to your oil and your gas prices, or if there's an event like China stopping tungsten to Japan, who exports chips into the US, and those chips are now more expensive, and so your computers are more expensive, and there's a cut along the chain that ultimately will make it more expensive for some products for some consumers. This is something that happens regardless of what's going on with supply chains in terms of major movements, because there's all these structural movements happening all the time, which is basically part of general capitalism. But what we've been seeing more recently is actual targeted export controls and restrictions coming on very important parts of supply chains that don't get as much news coverage. For example, on June 22nd, when President Trump announced that there was going to be some sort of an agreement resolution about the Strait with Iran, which is still kind of in debate, but when that was announced, and that was the public headline for most of the news, in the backdrop, China effectively restricted any sort of processed rare earths, which it owns 90% of the entire global process chains of, going into the very companies that the U.S. has taken equity stakes in, which are MP Materials, USA Rare Earths. So what China did was it didn't create a tariff. It just said, no, you cannot export anything along the rare earths chain to these companies that the United States has now put an equity stake in, for which it has to raise more debt. You know, when the U.S. decides to pay money for something, it has to come from somewhere. It comes from people. So the question is more, where is your higher cost coming from? Is it coming from the fact that, for example, in this situation, the U.S. is like 40 years behind the supply chain in rare earths? So does it come from that expense of trying to rejigger some of that and bring back some of that supply chain control to the United States? Or does it come from the fact that because China has control, it's restricting exports, which is making things more expensive anyway? So the end of the day is the consumer and smaller companies along supply chains ultimately have to pay a price either way. It's just how that price is communicated to them. Is it coming because of building an infrastructure and writing something for the future? Or is it coming from uncontrollable external restrictions that will also squeeze the price? Either way, the consumer will probably feel both. But the question is, are you creating a long-term independence, or are you paying for what has been a long-term dependence?
So we have a few minutes left. Final question. Tell us about the opportunities, investment opportunities that have arisen from these distortions, supply chain or otherwise. And we've talked about this in the program last time we were on. Have you changed any of your stances since a couple of months ago?
Well, one of the things that we've been looking at quite closely is how distorted the silver market was because of how big the ability to paper trade silver had been and why it was hit more than gold. We addressed it a little bit, but the numbers, just to reiterate, if I didn't say them last time, but looked at them more recently, is closing the last quarter, as we closed June into July, and particularly we had a larger sell-off at the end of June in silver and in gold, but silver more so. The SLV contract, which is the biggest silver ETF contract, where a lot of Western investors actually purchase their belief in silver as opposed to physical silver, it was trading 50 million ounces equivalent of silver per day versus its average of 25 million per day. The numbers on an annual basis, just to do the math, means that about 5 billion to 10 billion annualized equivalent ounces of silver trade in just one ETF. So when it gets hit by a headline, by an exaggerated programmatic AI, by whatever, it comes down hard and fast. And along with it, any of the equities that are attached to it, because there's only 820 million ounces of silver being produced each year. It's a significant distortion gap between what happens in paper and what happens physically. So the silver market is something where, again, be selective on mining, but that distortion has created some immense opportunities for people who did not get involved in miners in the first part of the leg. Also copper. Copper held in through this period, and it continues to hold in because it doesn't have the same paper trading mechanisms that silver or gold has, and it is a critical mineral, and it's necessary. And China just restricted sulfuric acid, which is used to leach copper. So we've been recommending very successfully junior copper developers outside of that belt that don't use as much sulfuric acid in their equation as key upside potential takeover targets for the larger majors as they continue to open their supply chains. And the same thing on rare earths. Rare earths are even way more junior than that. It's not a part of the market most investors are comfortable with. But if you're going to learn something new this year and invest in something new, investing in rare earths or very hard heavy metals like tungsten, like antimony, like graphite, like gallium, these are things that should be just a little bit, one investment on the radar. And these are the companies that we are actively looking at now for this period of basically geopolitical commodity warfare.
Geopolitical commodity warfare. I love that. That should be the title of your next Substack piece, if it isn't already. Thank you so much, Nomi. Where can we follow you for your writing and your trade recommendations?
On prinsice.substack.com. And if people go there, there's different tiers, but I fully recommend the founders tier because we're going to be expanding who's ever in that. That's the highest tier to a new product that's going to come out in October exclusively for them. So that's where we're putting the sort of largest upside trades.
Good. We'll put the links down below. Make sure to follow Nomi there. Thank you so much, Nomi. Thank you for coming on the show again.
Thank you so much, David. So
great to see you in person.
You too.
Thank you for watching. Don't forget to like and subscribe.